What if I told you that the car you were driving was already paid for the day you signed the loan, and the bank just flipped the script to make you the debtor? Now, today I'm going to be breaking down the big picture about auto loans, how they really work, and how discharge ties to it. Now, before we dive into this video, this is not legal advice. This is not financial advice. Remember to do your due diligence, okay? If you'll do your due diligence, then I'll keep making videos like this. All right. Number two, if you're brand new, hit the like button, hit the subscribe button. We post daily content, get daily content Monday through Friday. Make sure you guys stay tapped in. Now, my topic for today is auto loans. Okay. Our auto loans for my grammar police. And I wanted to talk about this is because I just happened to pull up the community and I seen a comment of somebody asking about how to be able to discharge auto loan. Now, when I seen that comment, there's a couple things that went through my mind. Number one, I thought about it. I haven't done a video on auto loans in a while, really because I feel like it's already there. But I feel like just like with anything else, I could just redo the video and break it down, or try to break it down in a different way or from a different angle, and maybe this will be the video. Okay. I also thought about it from the other element that auto loans are no different from any other loan or any other debt. It's just the strategy that you have to take is a little bit different, because your car could get repossessed potentially, because you could lose collateral and things in that nature. So without further ado, let's dive into how auto loans really work and really talk about the strategy behind challenging auto loan debt and potentially getting a car for free. All right. Now, just to break down what happens. Okay. When you go into a dealership, you think the bank is lending you money for the car, but here's what actually happens. You sit down and you sign a promissory note. That piece of paper is not just an agreement. It's actually a negotiable instrument under UCC 3-104. Now, under UCC 3-104, it says that a negotiable instrument is an unconditional promise to pay. So understanding that it's an unconditional promise to pay, this is something that is a financial asset. Now, by signing it, that's what makes it a financial asset, because only you have the authorization to make it a financial asset. The bank takes that note and then deposits it in their books as an asset with real value. But this is something that they don't tell you. Once it's deposited, the bank turns your note into a credit and then advances that credit back to you. And this is what they call a loan. But here's the trick. You originally funded that transaction with your own signature, because only your signature can create an obligation or complete an obligation. And the bank simply acted as a middleman, kind of like a wholesaler. If you know anything about wholesales, you know that what they do is they sell contracts. They're not necessarily selling a home. Someone gets a property under contract. They don't really front their own money. They then find a motivated buyer, and then they sell the contract to the buyer at an upsell. Okay. And then they get the in between. This is what the banks are actually doing, okay? And then not even to talk about the dealership. You think the dealership really plays a big part in this? They do, because they are the ones finding the motivated buyer. But once you apply for credit, it's really out of the dealership's hands. Your battle is with the bank that loaned you the credit, okay? So they really do this, and they flip the liability onto you. And this is what's actually happening when you are applying for an auto loan, okay? They hand you the car and they say you owe us for the next 60 to 72 months, even though your signature was the money that made the purchase possible. The only way that they're even able to release this car to you is because of this elaborate system where when you sign a loan agreement, it's actually a bond that can be monetized by the bank. Because you pretty much signed that bond, they actually release that car to you as a benefit, because they're getting more than what you are actually signing for. And when you think of a contract has to have a meaning of the minds, and also at the same time, there has to be real consideration and even exchange. If there isn't an even exchange, then this isn't a true contract that can be enforced. Now, what would the even exchange thing be? You think that the even exchange is your car. You sign and you promise to pay them overtime for a particular car. But it's not an even exchange because you give them more than what you actually get in return. See, what you're getting is a $30,000 to $45,000 car. But what they're getting is that multiplied by 10, and then they're able to then sell that very note. And then on top of that, they have multiple benefits through the FDIC. They have multiple benefits through insurance companies, the ability to be able to publicly trade it through Wall Street as mortgage-backed securities. They asset-backed securities. They already, they're able to make multiple off of what you originally signed, and all you got was a $45,000 car. Do you think that that's something that you would sign into knowingly if you knew that that was the case? See, and this is why those contracts are easily unenforceable, because of the simple fact that they're not even providing the same exact value that you provide. And it can easily be argued. Well, I won't say easily, but you can make that argument. This is why when you hear that your debt or your auto loan has already been prepaid, that's because it is. Because the value, or you're not able to extract they're not even able to extract the value from something, or at least that negotiable instrument, unless you sign. Okay, that's what we mean by when we say it's prepaid. It's not that there is money that just gets released, or you have a magic power. You know what I mean? Like your actual signature is the money. It's literally like you giving them authorization to be able to trade it, if that makes sense. Now, to truly talk about what is happening behind the scene, I have to talk about the double accounting that they are doing. Okay. And in order for you to understand this, it's called a double entry trick. Okay. So pay close attention to what I'm about to say. Also, everything that I'm talking about is not legal advice, not tax advice. Do your due diligence. And I only say this to really spark interest, okay? And understanding. Because if you understand this, then it will be much easier for you to challenge debt collectors. And it'll be much easier for you to fully understand how auto loan works in order to be able to discharge it. Because you have to know this part and not believe it, but know it in order for you to actually be able to enforce it. You can't be going off of a hope, okay? So the hidden accounting move that banks use to trap you into this debtor role is when you sign that promissory note, the bank deposit it as an asset on their balance sheet, and that's essentially the credit that you created with your signature. When you are extending credit, this is what's actually happening. And at the same time, they record a matching liability, the loan they claim they gave you. So what they do is they record that $45,000 as an asset, but then they create a $45,000 liability. So it's almost like saying plus 45, but then saying after they have added it as an asset to their books, that $45,000 to their books, they then minus out that $45,000, or they do a accounting trick to make you think that they are then loaning out that $45,000 that they just acquired. But the missing piece is the fact that you actually brought that $45,000 to them. You know what I mean? And they gave you what you kind of already gave to them, if that makes sense. But they make it seem like that came out of their reserves. It didn't. Okay? So they do it both ways. They add a $45,000 and then they minus $45,000 at the same time. All right. So in their books, there's an asset showing your note, your signature, and your credit. And then the liability shows that $45,000 that is now gone. But here's the con. You only see the liability side. You get what I'm saying? You only see the side where it says negative $45,000, and the bank never shows you the asset that you created. They never tell you that what you created was an asset for them. So they hand you paperwork that says that you borrowed $45,000, $30,000, and now you must pay it back with interest, which also is a scam as well, which is also constructive fraud as well. But in the reality, that 30,000 came from you. And then minusing it out, it was no point of them minusing it out because it shouldn't even like reach them as an asset first before it got to you. Because if that was the case, you would have just took the $45,000, gave it to them, and they could have just recorded it as an asset and kept it pushing. They didn't have to record it as an asset and then put a minus asset. All right. So they do this and they flip the narrative. Okay. They reclassified what you just did and made it seem like it was a loan in their books. So this is why the debt cycle feels endless, because you already created the value, but they booked it in a way that makes you believe that you are going to be in debt forever. It's not really real. It's a trick that they are doing. And before I go off on a tangent, I wanted to talk about, why cars get repossessed as well. Because a lot of times people don't understand, okay, if I'm able to do this or if my car is prepaid, why are they able to repossess my vehicle? We're about to talk about that right now. They use repossession as more of like a scare tactic and something to strong arm you into paying, okay? Because if you stop making payments, they claim you're in default, but default doesn't mean that they lost anything. Remember, they already got their asset from your note. Default essentially is them enforcing performance under the contract where you agreed to be the debtor when you sign, so that when you don't perform, they seize your collateral. That's what the agreement says. That this contract requires performance. So people run into the case where they do not perform, whether it's you don't pay, you don't perform. And when you look at the definition of payment, it does say a performance of a duty, performance to discharge of a debt. And all of this could be considered performance, but you have to be intentional. If you are choosing to stop paying your bill, then you don't just stop because you just learned that it was prepaid. You stop and then you move with intention. Okay, how else are you going to perform on this contract? It is a contract that requires performance. You must perform. That's why they're able to repossess your vehicle, not because this is when it starts to get to a point where they're using very specifics, okay? But this is where you got to kind of take them outside of that, where now they're focusing on a contract that was fraudulent in the first place to enforce why they can repossess. But when you challenge the contract, it nullifies whatever performance that you have to make. Because if you're asking them, hey, if you prove X, Y, and Z, or prove your claim, and then I'll perform, that is you not perform. That is you performing. Okay. So under the FDCPA and UCC and Article 9 of the UCC, which is secure transaction, they still have to prove their claim. So as long as you have them prove their claim, then that right there can be able to stop the argument that you're not performing. Okay, they may still repossess your vehicle, but it does stop the argument that you are not performing. Okay, so this must mean that they must show that they actually use their own money, they risk their own money, and that they loan their own funds and didn't just monetize your signature. This is important because if they did do that without your knowledge, that is a lack of disclosure, which is it breaks the foundations of a contract. So most of the times they can't produce this evidence because the transaction was funded by you. Why would, out of nowhere, they would have modern money mechanics, which breaks down how loans are actually created, have 12 USC 1431 that breaks down that they don't actually loan money, they borrow and give securities. You know what I mean? Why would they have these things put in place and you're the only one that they funded? You know what I mean? What would be the whole point of them having these provisions and subchapters and, statutes in place that confirms that they use us to be able to loan or create credit? How would they be able to produce some new evidence that they loaned you their own reserves when they can't even make money without us? Okay. So the question that you may still ask is, why do repossessions still happen? Because people don't know how to challenge the process. They don't send debt validation demands. They don't conditionally accept and flip the burden back to them. And they don't operate as the creditor. The banks rely on intimidation and silence. They rely on you not responding back to their claims. They rely on you not operating as the creditor. You operate as the debtor, and if you move with that energetically, then yes, they can assert all those rights or non-rights that you have as a debtor. So if you don't know your rights, you simply have to hand the car back and keep believing that you failed to pay. But the only way that you have to prove that you know your rights. And that's what makes it messed up. And that's where people get jacked up when it comes to this. Like, why do I have to prove it? Well, just like in a criminal case, someone has to, even if someone was to shoot somebody, they have to prove that they actually was shot by the person that they claim shot them. You know what I mean? Even if they did it, if they cannot prove it, then it doesn't stand as truth in law. And it's the same exact thing when it comes to debt collectors. Okay? The truth is, repossession isn't about recovering a real loss. It's about keeping you in line, reminding you that you are the debtor if you don't challenge the contract. This is why when it comes to auto loans, what you are having to do is challenge the contract. And this is why I say it's not that easy. When you think that you're getting a car for free, you are literally just open up the floodgates for a negotiation because the way this system is laid out. And yes, this could be frustrating to some people. Okay? It's frustrating, the fact that we have to go through all of this just to be able to get what our God-given rights are. But again, anything that you get in this life, you have to work for it. Okay? Yes, we are entitled to the natural resources and things in that nature, but you know, God didn't put things, he doesn't just like hand you things. You know what I mean? Like, there's a reason why you have to go get water. There's a reason why you have to plant seeds. There's a reason why you have to build things for yourself, infrastructure. There's a reason why God made it so that you can do things, but he's not just going to willingly like just give it to you, if that makes sense. You know, he wants you to work for it. You know what I mean? And so this is not to say that we aren't supposed to be, you know, getting these things for free, but there is an element that we have to put energy behind it in order to get what it is that we want. So I want to give you the big picture discharge path that you want to take when you are attempting to discharge your auto loan. Now, hit the like button, hit the subscribe button, turn on the post notifications, because I'm about to tell you the step-by-step process in 5 steps on how you're going to be able to discharge your auto loan. So make sure you stick around and you pay attention to this part. If you've gotten this far, comment the word discharge in the comment section down below. Okay? Now, I go through this in every video. All right? And it's not that any of the process is different. It's the same. It's just the matter of how you strategize depending on what is going on behind the scenes. Some of the steps that you want to take prior before you do anything. All right. So here's how the private side and the discharge side works when it comes to auto loans. If you want to get that car for free, you want to make sure you get this part here and take some notes. All right. Number 1, you want to start with debt validation. Under 15 U.S.C. 1692G, you have the right to demand validation. The reason why you want to start with validation is because if the lender or collector cannot provide proof that they actually loaned their money and they just recycled your note, their claim collapses. I tell you to start here because it would be no point of you sending in a coupon or no point of you doing any other negotiable instruments until they can prove that they didn't use your negotiable instrument. I start with debt validation with any debt collector because that right there, I don't want to automatically promote that I have a debt to be owed. This is why I'm going to ask you first to prove that the debt is real, to provide a proof of claim before I start diving into paying or performing on the contract. I need to make sure that this is a valid contract or a valid debt. So debt validation or conditional acceptance, especially if they send you an offer. After the debt validation, if they're able to provide proof, okay, which they will not, you want to dive into coupon remittance. Every monthly statement comes with a coupon or remittance slip, and that coupon is a pre-structured negotiable instrument, and by endorsing it and returning it, you are instructing them to settle through accounting entries instead of cash. Now, if you do use a coupon, you need to include a notice of tender or some type of cover letter that breaks down exactly what it is that you want them to do with this and what it is that you're sending back. I accept this for value, and I want you guys to have this on my account reflect. Okay, this is what you want to put on the coupon. You want to endorse it using 31 CFR 328.5 and 328.6. The instructions are there. Okay, you don't have to put UCC codes or whatever the case may be, all the BS. You don't need to do that. All you need to do is literally follow 31 CFR 328.6. It tells you the step-by-step instructions. You understand what I'm trying to say? Now, the coupon remittance is one thing, but you can also use forms like 1099-C, 1099-A, understand 1099 OID events, anything worth 1099. It always depends on the type of account it is, okay? If it's a student loan, it's probably a 1099-S or something like that. But if you can find evidence of a 1099 related to that account, more than likely it's been charged off or discharged. This creates a paper trail that the IRS recognizes that that balancing of the books has already happened. Okay, so putting the lender on notice that the liability has been addressed, this right here is positioning you for a case of them not saying that the debt wasn't discharged. If they even at any point explain that the debt has been discharged, it nullifies their claim against you. Okay, you can also find 1099 OID events. Okay, you can also enforce them to provide you the 1099-C, the copy of it for your own evidence, because a charged off debt is a discharge debt. Okay, step 4, and this is when you have a trust. Only when you have a trust you want to dive into this, but you can file a UCC1 financing statement and secure your claim as the creditor. And it's just your way of giving public notice. You can still give private notice in your letters, and I will still tell you to do that, but filing the UCC1 is giving public notice that you have claim over whatever collateral is. Some people do this for their birth certificate. Some people do this for their vehicle, their home, whatever the case may be. But only for secure transactions, anything that fall under UCC Article 9. And then step 5, conditional acceptance and tender in honor. If you don't refuse, you conditionally accept. I conditionally accept. I will pay if you can prove your claim, is the whole language of this entire conversation. And if they cannot prove that they risk their own capital, they move into dishonor. And under UCC 3-603, a tender in honor is a recognized way to discharge obligations without traditional payment. The big picture is this: you're not skipping out on paying. You're using lawful tools of discharge that already exist, and the banks know this game, but they count on the average person never playing it. So you just got the step by step. You're going to start with debt validation. Along with debt validation, if they are able to validate the debt, and only if they can prove their claims and prove that the debt is valid, then you dive into coupon remittance. Check it for 1099, filing a form 4506T to be able to get the accounting from the IRS, UCC filings, and moving in honor, okay? And getting them to dishonor, challenging them when they do when they don't properly validate the debt, or when they don't provide the proof of claims. Being able to send them a certificate of non-response and say, hey, look, you guys didn't respond to my last claim. Yes, you may have said what I did was fraudulent. Here's my rebuttal to that. But you guys still haven't answered X, Y, and Z. And this is why I'm not paying. All right. So it's no question when I go to the judge, or when you decide to say that I default, I'm just going to pull up that, hey, I didn't default. I just simply asked the question and they couldn't answer it, and I have a right to ask these questions. All right. So here's what this means for you. The auto loan was never truly a loan. It was a credit transaction funded by you. So the aspect of discharging the debt is proving that you already funded the loan, okay? Or having them prove that they did, you know? And it's typically after you get it under contract. You're not gonna go to the dealership and you're just gonna get a car for free because you know this stuff. It's gonna take proper process that you have to move in good faith and good honor, okay? If you sign that agreement thinking that you was going to be paying them back Until it's challenged, that's what you have to do. Until you challenge it. Not that you hear Nicholas talking about it and it's like, damn, Nicholas was right, or Nicholas is saying something right, so I'm gonna just stop paying it and hope that they seen Nicholas' video fighting for me. No. Understand that discharge doesn't mean that you're skipping out on obligation. It means that you're understanding how to lawfully settle your claims, and that is okay. That is just business. Once you see the big picture, repossession and defaults and endless payments, all of that starts to look like illusions, and you can start to move fluidly within this system. So the next time someone tells you that you owe the bank for their car, remember this: their signature funded the car, the bank just recorded it in a way that keeps them performing forever, and discharge isn't a trick, it's an actual remedy hidden in plain sight. So if you gotten all the way to the end, thank you guys for watching this video. Down below I have the school community you can tap in for 7 days free. Number 2, hit the like button, hit the subscribe button. Thank you guys for watching the video. I'm gonna keep dropping more videos like this, going back to some of my old topics and really cleaning them up. So let me know down in the comment section what you want me to talk about next. I love you guys, and I'll see you in the next one. This video is sponsored by the Fund Yourself Academy. My step-by-step system designed to help you fix your credit, get funding, and build real financial freedom from scratch. If you're tired of feeling stuck, overwhelmed, or just ready to stop living paycheck to paycheck, this is where it changes. Inside the Academy, I break down everything from consumer law secrets that they don't teach in school to how to remove negative items and boost your score, get access to business funding, and start building multiple income streams online. Whether you're just starting out or ready to level up your game and get the bag, this is your playbook. We've got tools, templates, dispute letters, mentorship calls, private community access, and an exact roadmap I use to leave my 9 to 5 and create time freedom. But only for a limited time, you can get access to the Fund Yourself Academy on a free trial basis for the next 7 days. And then after that, you pay less than $1 a day at $27 a month, if you like it. No fluff, just facts and just freedom. Go to the fundyourselfacademy.com or hit the link in the description to join now, because nobody's coming to save you, but you can fund yourself.